guy.
Welcome back to Give Me Some Truth. It's Mitch DeWitt here. I also have Alicia Vandeven in the room. And this is my second time in 2 weeks, I want to say, that's recording. So it's fun to be back yet again. But instead of Keith this time, it's Alicia. And we are going to talk about continuing our theme of the 2024 Walkner Condon Outlook. And we're going to talk about Alicia's piece this time around. So Alicia, do you want to give us a quick little heads up about the piece that you talked about, and then we'll dive in and explore a little bit more here.
Yeah, so I decided to write about basically how people's behavior can get in the way of their decisions to invest, not invest, trying to time the market basically, and how things like loss aversion and overconfidence can really cause people to make decisions that aren't necessarily based on facts, but are more based on emotion. And so a lot of it is just trying to take some of the emotion out of investing so that as investors, we can look at it from a rational perspective instead of letting our emotions get the best of us.
And one of the phrases that you hear sometimes, maybe you've heard it, maybe you haven't, but it's not timing the market, it's time in the market. And we can explore what that means a little bit. You'll see in the Outlook, there's a beautiful chart, which we'll talk about verbally here, but there's this beautiful chart that Alicia found and used as a data point that can just point to some fun numbers and things that really show that phrase to be true. Like there's a reason that phrase like that exists.
Yeah. I mean, whenever you look at the data that has been proven kind of time and time again that staying invested for the long haul is how you're going to get the best returns. In that chart, they actually say that 7 of the 10 best days in the market actually occurred during bear markets. So if you're sitting on the sidelines of the market, kind of like waiting for the bear market to be over, you're actually missing some of the best days to be invested because you don't know when those days are going to be. And so the more time you sit on the sidelines and you're not participating in the market, you're missing out on some of the best days to actually get some of those market returns.
For sure. And timing is one of those things that, of course, if you get it right, it could be awesome, right? But how many people can get it right? And the answer is, well, not many, turns out. If you had that crystal ball where what was it? It was, I wish I remember the exact date, but after the COVID trough, I'll say it was like March like 9 or 10 or 11 or 12 or whatever that day was. Like,
yeah, March
if
of 2020.
you knew that day and you invested, you were all in cash, and all of a sudden you knew, I'm going to buy whatever day in March that was in 2020. And then it just rocket shitted up. I said rocket shitted. I apologize.
Rocket ship.
Out of the COVID market crash there. So in any event, market timing, right, for most people is not going to be a good strategy.
Yeah, because you also have to time the market right twice. You have to know when to get out of the market, and then you have to know when to get back in.
Yeah.
And so even if you time one of those things correctly, you have to time the other one correctly too. And in practice, what we see most clients wanting to do is the opposite. The market goes down, and that's when they want to pull their money out. And when the market's at the highest, that's when they want to put their money in. So oftentimes it's our job to sort of kind of help clients realize that that's what they're doing. And I feel like that kind of feeds into the Vanguard study where they try to quantify the value that a financial advisor can bring to the table. And a lot of people say, they look at it just as like, well, what's the return that you can bring me, right? What's the return on the assets and the portfolio that you manage for me? And there's a lot more to it than that, in addition to just providing financial planning, which is a value in and of itself. They actually assign 100 to 200 basis points to behavioral coaching. And that can be something as simple as a client coming to you and wanting to sell out because they're scared, and you getting them to say, hold on, maybe don't do that, and here's why. So sort of preventing some of those emotional reactions that clients have, that if they didn't have you as an advisor, they might make some of those emotional decisions, and just helping to coach them through those moments can actually have a huge impact on their long-term returns.
Definitely. And just for definition, I don't know who's all listening to this podcast, but 100 to 200 basis points, we'll say 1 to 2%, in other words, is kind of the additional value. And this is according to Vanguard. So Vanguard, one of the kings and early entrants into the index fund concept, low cost investing, bring it to the masses, right? And this could be a whole other podcast. As a matter of fact, we may have done a podcast on this topic in the past, but they attach a value to things like that. And that's just the behavioral piece. Now, another thing is kind of interesting, and maybe you could talk a little bit to this, Alicia, but your education and background and how you kind of got interested in this whole behavioral finance space.
Yeah, so in my master's program at Kansas State, that's where I went to fulfill my education requirement for the CFP. But to round up my master's degree, I got to pick a specialty. And one of the reasons I really like Kansas State is because they offered a financial therapy program. And a lot of people say, what's financial therapy? And really what a big part of that was behavioral economics. Why do people make decisions about money the way they do, even if it's not in their best interest, it's not the most economical? A lot of emotions get tied to money, and that can really change the way that we spend, that we save, and just how we view money. And that can have a big impact on people's ability to work as long as they need to, save for retirement, be successful in retirement, not run out of money. All of those things can have a big impact on that. And so I was really interested in the behavioral side of it, because a lot of times, you say you can lead a horse to water, but you can't make them drink. You can give a client good financial advice, but if they don't take it, ultimately they're not going to be able to do the things that they want to do. And that's been an interesting part of the job is you give a client advice and that it's good advice. And for one reason or another, they really struggle to implement it. And there can be a lot of reasons for that. And if we can help untangle that a little bit for our clients and get them to even just take some steps, even if it's not everything, if we can move the needle a little bit, I think that's really helpful.
Absolutely. So let's look at some of the numbers here in this chart, because I think this is an interesting chart. And then, of course, part of our job in this podcast is to encourage you to go look at the market outlook if you haven't already, and check this out. All right. So, and by the way, as I'm looking at Alicia's title here, there are a lot of T's in this title. Timely tactics in market timing, ticking success, or ticking off trouble. How did this come about?
ChatGPT helped me write the title, I'll be honest. I kind of asked it for a bunch of different clever alliteration-themed title, with some puns in there. So yeah, I was trying to sound clever, and ChatGPT helped me out with that. So thank you, ChatGPT, for helping me write a title for my article.
Timely tactics, market timing, ticking success, or ticking off trouble. Say that 5 times fast.
Yep.
That's difficult. Okay. All right. The cost of timing the market is what this chart shows here. And Sam, are you live on this? This would be a fun little game. Are you live? Can you talk into this? Okay.
Definitely.
All right. So value of $10,000 invest in the S&P 500. So the time frame is January 2003 to December of 2022. And now granted, Sam edited all this and did a lot of the charts and everything. So maybe you committed this to memory already. But if you had that $10,000 solely in the S&P 500 starting January of 2023, and it was invested missing the 60 best days, how much would your $10,000 be at the end of 2022?
Be 4,205.
Oh, so you have it in front of you.
He's got the chart pulled up.
Oh, man.
I'm running the podcast. I have to have the info.
I was going to play the guessing game.
If you were honestly asking me, I probably would have guessed it would have been split in half, at least.
Okay.
Just looking at what I know from friends and my mom who works for the IRS. It's that she helps me a lot with this stuff.
Okay. What about your coworkers? Never mentioned coworkers in there.
None of my other coworkers until now have been financial gurus at all.
Okay. All right. So let's go to Alicia then, because you may not have this these numbers committed to memory.
Don't.
What about if you miss? So we said the first one that Sam said missed the 60 best days during that time period, and your money is, investment returns are quite a bit lower. All right. Let's say you missed the 30 best days during that time period. How much is your $10,000 worth at the end of December 2022?
Somewhere right in the middle there. I'm going to say, if I had to guess, 30 best days. I feel like you'd be close to right back where you started.
That's a great guess.
Somewhere right around
it's a little bit of growth.
10K.
You still get a little bit of growth, and it's 11.7. So 11,701. So you do get some growth.
Yep.
But all things considered, over essentially a 2-decade period, that's not great.
Not great.
And that's just missing 30 of
days.
The best days.
Yep.
So then it goes down to missing the 20 best days, missing the 10 best days. And as you imagine, you get more and more the longer you're in the market, right? Who would have thunk? And then if you're invested in all days, you want to throw a number out there for that? Maybe you remember that one.
I don't remember that one. I remember it being significantly larger.
Yeah. It's up 6-fold. So then you're $64,844, and that's just throwing $10,000 again, S&P 500 over that period, January of 2003 through the end of December of 2022. So it's just we know this, like we talk about this, we've seen studies like this, but then still sometimes you have to reset and think, holy cow, that's a significant difference, and that's just 10,000, right? I mean. The numbers can amplify, of course, from there, but that is the cost of time in the market. The cost of time in the market, you can put dollar amounts.
You can
to
quantify
that.
it. Yep, exactly. And so, that just shows how important it is to be invested for the long haul. And so when you have that kind of time horizon, if you're investing for something that's 20, 30 years away, you're in your 30s and you're investing for retirement, I mean, just put the money in, leave it alone. Mm-hmm. And that can be difficult to kind of just know that, hey, you got time on your side, and the market's going to do a lot of things between now and then. But if we didn't think that the market was going to go up, we wouldn't invest. Mm-hmm. And that's why we do it. So
one thing I think is interesting, and this is part of the beauty of how 401ks are set up, in my opinion, is just and this is really not even in most people's control, because every pay period, assuming you're electing to put money into their 401k, there's money going into it. It takes this whole timing discussion out, and then we call it, dollar cost averaging. So you're buying in at some ups, you're buying in at some downs, you're buying when it's flat, you're buying every maybe 2 weeks, maybe it's monthly, depending on how you're paid. And part of the beauty of that is, okay, you're not saying, oh, well, I'm just dumping $23,000 in at one time. Now, if you're self-employed and you do a solo 401k or something, there are some exceptions, of course. But for the majority of people that are contributing to a 401k plan, you're not thinking about timing at all.
Yep.
It's happening automatically. It's designed that way kind of for a reason, in my opinion. So it's kind of interesting, because then you might have someone that's fully maxing their 401k, not thinking about timing at all, but then all of a sudden, oh, I need to put $7,000 into my Roth IRA, or maybe it's just my IRA. Like, when should I put that in, right? And it's a fascinating conversation, really.
Yeah, and we have clients who do that monthly, and we have clients who do that once a year. And for me, I always just do it at the beginning of the year and just kind of get it over with. And I figure I have that additional year of growth if I'm always doing it at the beginning of the year versus the end of the year. But sometimes it's just to take that emotion out of it, or to not have to worry about it. Clients like to do it monthly. And that's, a lot of times too, clients will come to us sitting on a pile of cash. And what I think is interesting is the number of people who come to us and are embarrassed. They're saying, I'm sitting on this huge pile of cash. I don't know what to do with it. And then that pile just grows and grows and grows and grows. And we've seen quite a few people in that situation. And, I don't know if that's a recent thing, Mitch. Like, I feel like we've seen that a lot in the last year, I'd say. Is that something that you saw, years ago, or do you think that's a more recent change?
We've always seen that, I'll say, but it has changed recently, because now it's harder to part ways from a high yield savings account because it's paying over 4%. So people may have been hesitant before just purely because of the safety. FDIC insured, it's cash. You can turn it, from savings to checking with a click of a button on your phone. And there's a sense of security. There's a lot of people that still find that sense of security in just the US dollar, having it in cash. It's accessible, it's liquid, all those things. But if you were like that before, and then, oh, by the way, now you're getting 4.5%, we'll call it, on that cash, it makes it that much harder to kind of part ways with that. And some people, we're talking hundreds of thousands of dollars here. That's not everybody, but that can be tough. It can be tough.
Yeah, for sure.
So then comes the whole discussion of, well, just because, let's say above and beyond emergency fund, you got $200,000 to deploy, you don't have to do it all at once, right? Kind of back to the 401k mentality of just the dollar cost averaging. Maybe part of that plan to part ways from some of your excess cash is disciplined investment approach. Mm-hmm. Maybe it's X amount of dollars over Y amount of months, right? There's nothing wrong with that.
Yeah, and I think that's a good way to do it. Again, you're taking the emotion out of the decision. You're not saying, well, I have to decide when I'm going to invest $200,000. You say, I'm going to invest $10,000 a month or $20,000 a month until my cash is at a level that I want it to be at for my emergency fund or other short-term needs. You kind of identify what that goal is, and that's different for everyone. And just say, I'm just going to take this disciplined approach, take my emotions out of it, and just set up a monthly contribution to my account and just not even think about it.
Yeah. So another thing which I just thought of is this is an election year, right? Which most of us know, and sometimes there can be some volatility leading into that. And I don't have the numbers in front of me, but there's studies out there too of if you were invested just when the Democrats hold office or the Republicans on the other side, and it's kind of that same concept similar to the cost of market timing chart that we went through. But essentially, yeah, if you were invested only when the Democrats were in office, you'd be up, and it'd be a good amount, let's say. And if it's $10,000 and it grew to however many, tens of thousands of dollars from there, wonderful. Same thing on the other side. But then if you just say, I'm invested no matter who's in office, right?
Yep.
So I'm not just only going to be invested when the red team, so to speak, or the blue team, and then when the other team, I'm not going to be invested. That's a bad strategy. Just flat out bad strategy. Because that's another thing will come up inevitably as the election gets closer. People, clients, just conversations at a cocktail party that we're having, right? People are saying, hey, what's going to happen if so-and-so's in the executive office? What's going to happen if Congress looks like that, right? And really, we should be pretty agnostic from outside of politics, vote the way you want to vote. But when it comes to the markets, you can't really make a super strong bet one way or the other.
Because at the end of the day, if you're invested in the market, hopefully you're invested for the long term. You're not just investing for the next year. Because if that's money that you need in the next year or two, it shouldn't be in the market.
Yes.
You should have that.
Then you should have that high yield savings.
You should have that in a high yield savings account or in something shorter term like a treasury bill. People, if you're putting money into the market and it's money that you need soon, that's just a recipe for disaster. That's very risky. But if you're invested in the market and you're invested for the long term, ultimately it's not going to matter what the outcome of the election is, because you're going to see several more elections before you need that money. Otherwise we're having a different conversation of maybe that money shouldn't be invested that way. And I think the other thing here is Mitch and I talk about all these studies and these articles and things like that. And, this is kind of what we do every day is we read these articles, we look at these studies, we're fascinated by it. It's interesting to us, right? And, our clients aren't being bombarded with articles and studies about markets and the economy and how all of these things work together. And so sometimes it's easy for us to kind of know these things to be true because we've seen enough articles and studies that back up these things time and time again. But our clients who aren't inundated with all of this stuff, it's a little bit harder to know what all of those facts are because they're not doing the same amount of research that we are. And so, we do our best to try to share that knowledge with our clients.
Yes. And is there anything else that we should go through? Otherwise, it feels like a natural time to part ways with our friends at Give Me Some Truth. Are there any last thoughts?
Well, I think there's a lot that is still in the post. So definitely there's a lot still to read there about, exactly how loss aversion and overconfidence specifically, kind of affect market timing. Because I think both of those things have a lot of influence on it. We're much more sensitive to losses than we are to gains of the same amount. So that's a really interesting phenomenon. So I would say I would encourage people to go and read the article because there's a lot more great information and statistics in there as to how those sort of psychological biases, affect how we view investing.
Perfect. So that's your carrot. Go check out the Outlook, find it on our website, and let us know if there are any questions. That's the other thing. We're here as a resource. Feel free to reach out to the pro, aka Alicia, directly because she's the one that covered this topic quite well. I was just here to join in the podcast.
I'm happy to nerd out about this stuff anytime.
In any event, we're here as a resource. We'd love to have conversations with you, and please join us on the next installment of Give Me Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.
You gotta leave your money behind you. Raise your hand to the sky. Ask the masses for silence.